Today, folks, I am so damn excited that I just can't hide it, as we're going to get real with earnings and some of the stocks that I have been adoring, waiting for them to crash so I can buy them at discounted levels have finally come into fruition, because we're going to be breaking down the earnings that we've seen this week with stocks that just interest me. I mean, we're going to talk about dividend stocks like Verizon, 3M, heck, growth companies like Netflix and ASML, and my favorite of the bunch being Tesla, which is finally hitting my buy territories. We'll talk about that toward the end of this video, and if that is a conversation you'd appreciate, if you're on your path to financial independence to perhaps one day retire early like I am, go hit that like button and consider subscribing while you're down there to join me on my journey. Let's do this together, as the portfolio has been on damn fire for all those idiots out there, and I'm sure there's many of you, because I'm not trying to be rude, but too many people flooded into these high interest rate, savings accounts and ETFs and bonds and GICs. When I told you buy things when they're on discount, because the market's going bananas. It's like we're just printing dollars here. I mean, from last October, the market's up a lot, but it just never ceases to amaze me. The markets are up well over 20-30%. S&P hitting an all-time high here, and it's making a lot more than a high interest savings account, considering we're getting close to this interest rate cut cycle. But the portfolio, over $201,000, has been benefiting greatly from the S&P, which makes up a huge percentage of my portfolio. Google, we've been loading up, and I told you I was going to buy as much as I could before earnings, and we're, I think, sitting at over 150 a share today. Lots going on with this portfolio, so very excited to be hitting over this 200K mark yet again after that major real estate purchase last year. But let's get into earnings here. Let's try and calm down. Let's try not to be rude and offenseful to the cash savers out there. I am just a diehard. I'm young. I want my money in the markets and as much of it as humanly possible. So let's talk about some growth vectors with Netflix. One of my least favorite investments of the bunch, because I believe Google is just a superior streaming service, which we're going to see as we kind of break down the earnings here. And I'm going to show you a comparison between all the different streaming services and what's dominating. But Netflix is crushing it. You cannot deny the fact that their revenue growth is up 12% versus this time last year it was only growing at 1.9%. But they have made some very insane predictions that they need to pull through on now, because to forecast a 13% revenue growth and margins increasing to 26%, which would put them up there with all the major tech companies, is not a light statement to make, considering they've never done this over the last year in their past. So their forecast for Q1, get ready, but this was just jaw-dropping, and the stock definitely took a big bump. So congrats to everybody that believed in Netflix. But what I want to show you, and why I'm holding Google over Netflix, is the numbers they even share. Like, if you look at most places in the world, from Mexico to Brazil to the US, YouTube is the dominated streaming platform. And you look at companies like Mr. Beast, these brands, these mega billion-dollar, inventions that just came out of YouTube, really, and YouTube's not paying them, right? But you look at Amazon, and they have to pay Mr. Beast. There's a lot of controversy if they're paying him like $400 million or something to start building and making content for Amazon. But Google's already got that, baby. Google didn't have to pay crap like Netflix is paying out these huge numbers. But still, I got to appreciate Netflix is still crushing a lot in the streaming space, and it's nice to see. But let's talk about ASML, the chips. NVIDIA hitting another all-time high. If I was smarter and I recognized the growth that was in front of me that I've been touting, I should have just swing traded it, put some money in it, because it's up 20% this year alone. And ASML should be a prime defining factor to the growth that's going on, as ASML just hit an all-time high. This is that company that's taking tin, shooting it at crazy speeds, hitting it with a laser, flattening it out, hitting it with another laser, turning it into plasma, launching it through all these different, crazy mirrors, bringing it down to like nanometers of a thousandth of a nanometer of your frigging hair, and etching like little chips and basically, all those transistors into things that we're using in our phones. I mean, it's crazy. There's over 1 billion transistors in your phone, and it's all accomplished by this beautiful company's machines. And that is, something that NVIDIA is definitely using. But you look at the growth here. I mean, we're talking about 15 billion to 21 billion, almost $22 billion. I mean, total net sales jumped up beautifully. I mean, we're talking about damn good growth here for this company. So I'm very excited, because the chip industry is still benefiting so much from AI. And we're going to keep seeing that, as Meta has been like the #1 purchaser of NVIDIA's H100s. Those things cost like 40 grand. And I think Meta bought like 650,000 of them or something like that. Next to Microsoft, the two biggest purchasers, which means you should be excited, because I'm still, thank Godding, that my fiance has owned Meta and has been a lot more resilient with holding it than I have been, because she is crushing it. Meta's like been an unbelievable, base case for us, and I held some, but she's definitely kept strong, and it's paying off for her. So let's talk about some of the dividend pairs, the tried and true Ray Dalio's portfolio kind of stocks, right? Because you can see that we've seen a little bit of a bump up here, but it is pulling back, and these stocks have become boring. We'll talk about a few of these, and the reason I say they're boring is the growth days, I think, are largely behind them because of inflation. You take a look, their revenues are only up 3%, probably from price price increases, but as far as I'm aware, they've been seeing volume declines. Their gross profit is up 14%, and I would probably impact that to shrinkflation, because I think the only way they could be getting gross profit up and the cost of goods down is basically by, cutting how much you're getting per package, which we've seen with a lot of companies and a lot of different products like Procter & Gamble offer. And they're also paying out pretty heavy interest, right? Like their interest payments went up 45%. Though their interest income was up 102%, kind of balancing some of that out with their cash, leaving it in high interest savings. But again, that's going to come to an end. We'll see a balancing of, making less on interest income and, paying a little less on interest expense. But we're seeing the same with most of these giant companies like Canadian National Railway. You Canadians out there that love these kind of companies, I mean, you take a look at this. This company is just kind of maturing. I think it's not seeing the same growth. I'm not seeing the same investments that Kansas City Railway, that other railway company that I think is a little bit more intriguing here than this one is today. People are buying this for the dividends, but the growth has been absolutely stagnant for the last year. There's just nothing really going on here that is by any means exciting. I mean, the net income's down. Everything's just flat pretty much, give or take a couple $100 million. If you're into the railways, I'd love to know what you think about these, because I've always wanted to buy them. But like I said, I want growth. I want to get to financial independence. I recognize that companies or ETFs like SCHD or VDY here in Canada will give me exposure to the companies for income that I like. But at the end of the day, I'm young. I want to retire early, and growth is going to be the only thing that gets me there, because discounted companies right now are just not getting off the ground. You look at things like 3M that people have been touting basically since what? I mean, the stock's been in an epic decline since 2018. It kind of reminds me of Alibaba. Stocks that I would personally just avoid. It doesn't matter how good they look on discount, even like MO, I would probably just avoid them because there's just nothing going on. I mean, you look at their net sales are down. They were able to get some net income up here, probably through a few expenses they're not paying with lawsuits or who knows, but just not exciting, right? Like I would just kind of move past these and just say, hey, boring companies aren't always great just because they pay a high dividend. Companies that I would put on a list for recovery plays, though, are like telecom, infrastructure, maybe utilities. And I've said this, put some money aside for some of these dividend payers, because some of them are going to see a great recovery when the interest rate cut cycle comes around. And I think Verizon might be one of these as we take a look at their earnings. And one thing that I want you to really pay attention to here is nothing happens. It's boring. This company's not really going anywhere. Their total service revenue has been pretty much flat. Almost all in all, their revenues, give or take a few billion, are flat. But what's most fascinating to me is if you take a look at the interest expense, right? They went up 52% from 3.6 to 5.5 billion. And these are one of the things that'll eventually start coming back to the bottom line and start increasing earnings. So I'm going to be paying close attention to companies like this. I do prefer the ones on the Canadian side of the border like TELUS, but because they're hitting at least record signups, so they should start benefiting better from the interest rate recovery cycle, which will start this year and probably accelerate into 2025. But from a growth standpoint, I do like Google. I'm looking at things like Microsoft, but I'm looking for discounted growth. And as much as people might think Tesla's not discounted here, I think for the future potential that's coming in the next 5 or 10 years, especially related to robotics, is going to be a fascinating growth story that I definitely want to be a part of. And as somebody who made a lot of money on Tesla, I told you guys when I sold out of it, I've just been patiently waiting for things to catch up to the earnings, because right now everyone's only caring about income, cash flows, and Tesla's one of those companies like Apple that when you're selling physical products that are high value in a higher interest rate cycle, they just don't do well. But it's a cycle that will only last for a limited amount of time. And I think Tesla here, and as I said, as it gets into the 100 range, I would start cost averaging, and we touched it. I'm hoping we get down there. I don't know if it's going to stay down here, but we're starting to get close to the end of the cycle, I believe, and what will be a buying opportunity, because let's talk about a few things that stuck out to me here. Most of this has been abysmal at best. I mean, their production's great. They're getting deliveries, but they're having to cut prices and margins to do it, which we'll see. But one of the fastest growing aspects of their business right now that are the most interesting to me is the storage deployed. Their megawatt hours went up 125%. So clearly they've been installing some massive storage facilities. I mean, the storage megawatt hours, I don't know if this is just from personal people buying power walls or big companies that they've been installing some of these and getting them online have been, but very fascinating. Same with basically their supercharger connections. And their supercharger stations have been growing at a nice clip. A lot of things growing here that I think are underappreciated. But if we scroll down and just take a look at the total revenue, this is what I wanted to see happen. And I know people are going to be mad at me, but I want Tesla to crash. I want to buy it. I think there's long-term, mid-term potential in the next 5 to 10 years that is going to be well exceeding what the current value of the company is. But we can see total revenues have basically unchanged, 25 billion versus 24 billion this Q4 of 2022. So nothing exciting at all. Gross profit has gone down from 5.7 to 4.4 billion. Again, cost cutting, margin cutting. You got to keep sales going. I understand that. And this is the only company that can do it in the auto industry because, hey, they've got 106 billion in assets, 29 billion in cash, and against their liabilities of only 43 billion, their cash position can damn well pay off most of their current liabilities. And they're cash flow positive still, right? That's the most interesting thing about this company. And I am desperately excited to see what robotics is going to be doing. And I'm sure we'll get some updates on the call. So it's something to just pay attention to. I do love Tesla, and I'm definitely looking forward to getting back into this. And my waiting has paid off greatly because a lot of people have been hyping into this, but hype has died. And that is when I think it is time to buy, because that hype will quickly return, I think, when people appreciate the robotics and AI aspect of this, with version 12 of self-driving, with the robot well on its way. So I'll pass the question off to you guys. I'm very excited. I hope you're going to continue subscribing to see what I end up buying and how I end up buying it. But boo, baby, we starting to print some damn dollars. So let's get it. Stay cool. Stay awesome. And I look forward to catching you in the next one.